What if I told you that you could consistently average 50 to 60% returns on your investments trading in less than 30 minutes a day using this little known option strategy designed to minimize risk, maximize profits, and most importantly, stack the odds in your favor? As an options trader, it's important to understand that buying options comes with both advantages and disadvantages. It's really important to also understand how those advantages and disadvantages affect our trade's profit potential depending on what we are trading, how far price is expected to move, and how long it takes to get there. Now, the main advantages of trading options versus stock are they have limited risk, reduced cost to enter, and because of this reduced cost to enter, they have a higher profit potential. But there are three main disadvantages as an option buyer, which our little known strategy was designed to eliminate. Now, the three main disadvantages are, number one, all stocks are not priced the same and they don't move the same. So this means a couple of things to us as option buyers. Number one, it means stocks like Google and Nvidia aren't priced the same. Matter of fact, they're priced drastically different. And as you can see, a $10 move on Google versus a $10 move on Nvidia reflects a larger percentage gain on that stock, which leads us to disadvantage number two. Their options aren't priced the same either. Because stocks like Nvidia and Google are priced so differently and generally expected to move at different rates, so are their options. Now, this makes it more challenging to size your positions and profit from those trades on both stocks equally. Where a $1,500 investment into Nvidia allows you to buy just one option, and Google, you could buy four and then end up profiting 4 times as much from that same $10 move and even have some money left over. This leads us to disadvantage number three, the Greeks, theta, vega, and gamma, which negatively affect an option's price. Now, if you know nothing about the Greeks, here are the key things to remember. Delta tells you how much money your option will make per $1 change in the underlying. And theta will tell you how much your option will lose every day just for being in the trade. As expiration approaches, that number grows exponentially, meaning even if the trade has worked in your favor, you could still be losing money if it's not moving fast enough or hasn't moved far enough. For example, if we bought that Nvidia 415 call for $1,440 and Nvidia moved exactly $10 in our favor by expiration, that option would still have lost us $440. Actually, in order for that Nvidia call to be profitable, Nvidia needed to move over $14.40. So how do we capture the advantages of options, the lower cost to enter, the higher profit potential, while avoiding those disadvantages? Since how far stock travels varies, how much options cost vary, and how much options lose per day vary, we need a way to offset those differences so we can consistently profit from the one thing that we know is happening, movement, without having to maximize the capital we invest or fight theta. So let's take Google, since a $10 move there actually achieves a more impressive ROI and we don't have to fight theta for our option to be profitable at expiration. Now, if we expect Google to rise $10, we could profit from the price action in many ways, but let's focus on three. Number one, we could buy the stock. Let's say we buy 100 shares at $130 for a $13,000 investment. We could also buy that at the money 130 strike call about 2 weeks out for $350. Or we could buy a $5 wide vertical spread, buying the 130 call and selling the 135 for a debit of $225. Now let's assume Google moves $10 in 8 days. Our shares would have made $1,000 or about a 7.7% return. Now our option would have made about $404, a 112% return. But our debit spread would have actually made a 122% return and even collected theta. Now, what if Google only moved $5 in that time frame by expiration? In our first scenario, our $13,000 investment would have only achieved about a 3.85% return, where our option that we bought would now have only achieved a 33% return because theta was a real big problem. But again, our spread hit 122% return because it collected all of that theta instead of burning it. So how does this work? Well, let's take a look at Google and Thinkorswim. We're going to buy the vertical, we're going to select the option we want, we're going to adjust the short strike to sell an out of the money option $5 away from the option we're buying for a net debit. In this example, we are buying the 130 call and selling the 135 call about 2 weeks out, essentially creating a covered call position which says we want to buy Google at 130, and in 2 weeks, if price is above 135, we will sell it there for the difference minus the price we paid to be in. Now, debit spreads have a max profit defined by the width of the spread, in our case 5, minus the amount we paid to be in the trade. So, $5 minus $225 equals $275, or about 122% return. Debit spreads also have a max loss defined by the amount paid to be in the trade, so you can't lose more than you invest. Now, when do debit spreads become theta positive? Once price has passed your long strike, in our example 130 plus the amount we paid to be in, 225, so above 132.25, we are no longer losing theta, we are collecting it. So debit spreads actually allow you to invest less, risk less, and make more. So let's recap the advantages of debit spreads. Just like buying options, they have limited risk, you can only lose what you invest, and 2, debit spreads standardize your cost of entry regardless of what you are trading. A $5 wide, 2 week out debit spread costs the exact same on Google, Nvidia, SPY, Apple, QQQ, Tesla, etc. And I typically like to purchase these $5 wide spreads for between $2 and $3, targeting about the $2.50 area. So they're really your way to work smarter, trade smarter, not harder. Debit spreads will standardize your trade results, meaning more consistent and stable profits. Instead of wishing every trade has to go to the moon to achieve sizable returns, spreads only ask the trade moves modestly in your favor. Spreads reduce your risk to time decay and even make theta work in your favor, meaning instead of you paying a premium to be in the trade, they pay you. So consider our Nvidia swing where price had to move over $14.40 by expiration just for our option not to lose money. Using $5 wide vertical spread, you only had to have price move $2.50 to stay in the green, and $5 made you over 100% return. Now, if price continues to move in your favor, you can always capitalize by rolling up into a new spread. So how do we win up to 89% of our swing trades with debit spreads using the momentum options trading system? Swing Trader Pro. Through 2020 through 2023, Swing Trader Pro has had an 89% win rate. All you have to do is enter when you get signals at the close of the first 1 hour candle or at the end of the day. Take profit at targets. You can even set your orders in advance. And close if your trailing stop is violated or if an opposite trade is signaled. Just check in at the open and the close to manage your trade. That's all you have to do to win nearly 9 out of every 10 trades. Now, to learn more about my calculated approach to risk management and how to size your positions with debit spreads, watch my risk management video and download my risk management planner to start scaling your growth effectively. The risk management planner was designed to help you understand exactly how much capital you should be allocating towards each trade. It tells you the exact number of contracts you should be buying for each day trade, the number of spreads you should be buying for each swing. And it even tells you the kind of results you can expect with the Swing Trader Pro system should you want to take your trading a bit more seriously. Now, I hope you guys got a lot of value out of the content here today. Be sure to comment any questions you might have below. Thanks for watching and happy trading.